signed on. Good morning and welcome, or good evening, or good afternoon, depending on where you are in the world. This is the IAA webinar on IFRS 2, climate-related disclosures. My name is Simon Curtis. I will be the moderator today and also will be giving a few remarks as we go through the presentations. I'm a member of the Actuarial Standards Committee of the IAA, and I was chair of the ISAP 8 task force, which is the task force which developed the climate change model standard the IAA has developed. Hence, I'm hosting the webinar today. If you could advance the slide. Just a quick disclaimer note which we'll just quickly go through. So I think we can advance to the next slide. A couple of housekeeping items before we get going. First off, the verbal side of this has been turned off for the attendees. So we're going to allow about 10 minutes at the end, hopefully, for questions and answers. So if you have a question as we go through, you can submit it under the Q&A icon at the bottom of your screen, and then we'll try and answer the questions during the question and answer session. And also a reminder that we are recording the session on YouTube, and so a copy of the presentation will be available on YouTube within the next day or so. And I've used that myself a couple of times for other presentations, and it seems to work well. So if you want to listen again or have someone else listen, please do that. Next slide. I'm really happy today to welcome two excellent speakers. We have Dr. Jeffrey Hales. Jeffrey's a member of the ISSB's Standards Board, and so he's going to talk to us about IFRS 1 and S2, the standards themselves. And then also we have Evelyn Young. Evelyn is an actuarial consultant at Finity. I think we actually spelled Evelyn Young. I think we spelled her name wrong on this slide. I apologize. Evelyn's a member of the IAA's Climate Sustainability Committee and is on the group that drafted the International Actuarial Note on climate change, which supplements the standard. So Evelyn's going to be talking about the education note, and she's also a practitioner in this area, so maybe giving a few comments on that. Next slide. Before I pass it over to Jeffrey to talk about the standard itself, just to give a bit of context, in terms of the disclosure requirements overall, the key document and here is the entity disclosure requirements from the ISSB for climate-related risks and opportunities. And this is the document that governs the reporting standards for entities. On the IAA side, we've adopted or developing two papers to support that standard for actuaries who are working on these disclosures. One is our IAA standard ISAP 8, which is a model standard for actuaries providing services in connection with IFRS 2, and supplements these supplement the ISSB requirements. The IAN is then an education note which supplements the actuarial standard. This is very similar, by the way, to the concept we had with IFRS 17, where we had the standard that came out of the IASB. We developed an actuarial note standard, ISAP 4, which was for actuaries who were working on those valuations. And then there was IAN 100, which had a lot more detail on techniques and stuff. So this is a very similar pattern to support this standard. Next slide. And then finally, just before we get into the meat of this, the other last context. So the actuarial standard is a model standard, ISAP 8. It will be adopted in November at the council meeting. And it's a high-level principle-based focused document. So you shouldn't think of that standard as a technique paper. It more is about how the actuary should professionally do the work in terms of disclosures, reliances, what type of sort of qualification requirements are needed in terms of education and such, and then a few very high-level comments on technique issues. But IAN 200, which is I would call it more a guidance note, education note, is where you would find much more detailed methodology, guidance, and examples related to providing services for IFRS S2. So that's the sort of the context and background for the three documents that we'll be talking about today. Okay, so at this stage, I'm going to pass it over to Jeffrey, and Jeffrey is going to give a presentation on the standards, the ISSB standards themselves. Thank you.
Great, thanks, Simon, for kicking us off. Hopefully you can see my slides okay.
Yeah.
Great. Wonderful to be with everybody today to give an overview of IFRS S2, which is the ISSB's climate standard. We've got about 20 minutes to chat about it. That's not really enough time to understand it in complete detail, but hopefully you'll get a sense of what's in there, the points that could be most valuable for actuaries to understand as well. So the first thing to really understand about the ISSB standards, and in particular IFRS S2, is that it's building off of the what we viewed as sort of like the best of the investor-oriented sustainability-related guidance that was out there, and in particular on climate, we pulled from the TCFD recommendations that were published in 2017, and then also the SASB standards that have been in development for about 10 years now that are industry specific, about a third of which relate to climate issues. And so we pulled that climate content to help inform the industry-based guidance that is inside of IFRS S2. So one thing to understand, Simon mentioned S1 and S2. S1 is the general requirement standard of the ISSB, and we're not really going to have time to chat about it today, except to say that it sort of sets the stage for what the overall objective is in when companies are applying the ISSB's standards. And so when you think about what the goal would be, who the user is, what we would expect in terms of where the information would be disclosed, when it should be disclosed, what to focus on there, all of that gets sort of set by S1, and then S2 is going to, in a sense, unpack the parts of S1 in the context of climate. So if you were to look at S2, it talks about the objective, and the objective for a company applying S2 is to disclose not on any climate-related issue or on all climate-related issues, but all climate-related risks and opportunities that could reasonably be expected to affect the entity's prospects. And by that, we mean its cash flows, access to finance or capital, and over the short, medium, and long term. So what we're really looking for there is the information that would be likely to be material to investors, what could affect their decisions. And this is the same objective as S1, except that S1 puts that into the context of like all sustainability related risks and opportunities, and S2 starts to unpack that and say like, well, in the context of climate, what would we mean? And so for example, when we start talking about climate related risks, then we know that there are different forms. They could be physical or they could be transition risks. By transition risks, we're talking about the risks that relate to developments in regulation or customer preferences or new technologies, market forces, that sort of thing. So drawing from the four pillars of the TCFD recommendations, which focused on governance, strategy, risk management, and metrics and targets, S2 is going to ask for companies to disclose information about who's overseeing the climate-related risks and opportunities that the company faces. What's management's role there? Very important to recognize this is not prescriptive in the sense of saying this is the way that we think a company should structure its governance with respect to climate. It's really just asking what is the company doing. So when it comes to companies' strategies, we're asking for a discussion about how their strategy takes into consideration climate-related issues, if at all. That's up to them to decide what the appropriate strategy is, but investors need information about that. So if there is a climate-related transition plan that a company has put into place, that's something that we would expect companies to talk about, but we don't say that companies have to have that. Again, not prescriptive, but more like descriptive. Risk management, same sort of thing, asking about how a company has, in what ways it has factored climate-related issues into its overall risk management system, and then metrics and targets. So what we're going to do is sort of dive in a little bit more into B and D here, strategy and metrics and targets, because I feel like that's some of the information that is most likely to vary company to company or across time, and where also I think some interesting opportunities for actuaries will be. So when we think about what are the requirements on strategy, one of the very most important things is companies need to talk about what have they identified as their climate-related risks and opportunities. And so what we ask companies to say about that is to say, what do they see as those risks and opportunities that could reasonably be expected to affect their prospects? Do they see them as being primarily physical risks, or do they see them as relating more to transition risks? Do they expect them to manifest in the near term, or is it going to be more over the medium and or long term? And then also to talk about how that sort of gets factored into their planning horizon. So unlike some other standards, we don't specifically define what is short, medium, or long term, in part because we sort of recognize that what might be a medium term sort of planning horizon for a mining company might be much longer than, say, like a consumer goods or fast fashion kind of company as well. So, but we do ask companies to describe how it is that they are using the terms short, medium, and long term in their planning. Now, one of the important things is that climate affects many industries, the vast majority of them, but it does so in different ways. And so, one of the reasons that we drew from the SASB standards in pulling out some guidance related to climate disclosures is because they were developed on an industry by industry basis. And so, there are actually 77 industries in the SASB standards, which are now under the responsibility of the ISSB. And when we looked through them, 68 of the 77 had content that was related to climate. And so we pulled that out, put that out for public comment, and that's now part of the industry-based guidance on climate that is inside S2. So a company doesn't have to look through all 68 industries. The point here would be just to look for the industry standards that are most closely aligned with the company's operations, and you find the relevant guidance there, and then draw that out. So just to give a quick example of that, an e-commerce company could pull out the e-commerce volume of the industry-based guidance, and it would see a description of how hardware, infrastructure, and energy and water management are going to be topics that investors are likely to be interested in that relate to climate issues there. Also, product packaging and distribution being something that has climate-related implications, especially as we start to think about transition risks that could be arising in different regions. And you could contrast that with, for example, the automobiles industry. And so if you pulled out the automobiles volume of the industry-based guidance, the climate-related content that you'd find there relates to what we could think of as a scope 3 type of issue, which is relating to use phase emissions and for the cars that are being developed. And then, it doesn't just sort of list items, but actually, if you were to go ahead and open that guidance, you would see a description of what was intended when this topic was identified as something that is reasonably likely to be material for entities in that industry. So, moving on, the next thing that we ask for related to strategy is for companies to talk about how this is factored into their strategic decision making. And here, it's a qualitative discussion, but we're really looking also for some quantitative information as well. But thinking about how has the company responded to already, or do they plan to respond to climate-related issues? Again, if they have a transition plan related to climate, if they have specific targets that they have voluntarily set or that they are required to set that could have a material effect on their performance, then they would be expected to talk about those plans and targets. But we're also looking for companies to talk about how are they going to resource these plans. One of the things that we've seen in disclosures over the years is that companies often talk about something that they've done or something that they might plan to do, but not necessarily talk about how they're going to get there. And so you feel like for investors to really be able to distinguish one company from another and really evaluate these plans and targets and strategies, they need information to understand something about the resourcing related to that so they can see which companies are further along. Maybe just to look at that in a little more detail, it's unpacked to also ask companies to talk about current and anticipated financial effects. So when we think about those resourcing decisions, how is this going to play out now and in the future over your financial statements? So To take the automobiles example that we had just been talking about a little further, you could imagine that a company might have announced a 5-year transition plan to sort of develop alternative vehicles, or maybe move from a combustion-based engine to different kinds of low emissions vehicles. And they could talk about like where they are right now, what they're anticipating over the next few years. It's possible when talking about the current and anticipated financial effects, a company might, this is increasingly unlikely, I think, in the current state, because most car companies are pretty advanced on this. But you can imagine that a car company might say, well, we haven't done anything right now, but we plan to over the next few years, and to talk about qualitatively what that might look like, but also hopefully quantitatively as well. Like how much are they expecting to have to say to spend in order to invest, in a sense, in order to adapt their manufacturing processes. And if another company is also on a 5-year transition plan, but is able to talk about like how much they're planning to spend on this and over what time period, you could see how that could really help an investor to compare to peer automobiles companies. So. And then lastly, and this is one that's super important, I think, for the actuarial community, climate resilience. So we expect companies to not only talk about their strategy, but to assess the extent to which they believe it's going to be resilient to different climate-related scenarios. And so that's going to require companies to think about what might happen and to assess the resilience using different kinds of scenario analyses. So we expect them to talk about, we don't have a very prescriptive way to say, this is the scenario that you must use, this is the way that you must sort of view the world. That's up to companies to decide which scenarios that they think might be likely, which ones are they preparing for, but we do expect them to talk about that. One of the important things is that we recognize that there could be not only different scenarios that companies might factor in, but also they could do that with differing levels of sophistication. And so we also aren't super prescriptive in the sense of saying like, well, we expect every company to be really sophisticated in this sense. So the two of the things that we've built into the standards to help to address proportionality is to first expect that the level of scenario analysis would be commensurate with the risks and opportunities that a company faces with respect to climate. I mentioned 68 of the 77 industry standards had climate-related guidance in the SASB standards when we looked at that. So those 68 presumably have more significant risks around climate than the other 9 industries that did not. But in addition, even within that, you can imagine that climate-related issues are pretty existential from either a transition risk or a physical risk perspective in some industries. But that would vary. And so we expect the level of analysis to be commensurate with the risks and opportunities that the company has assessed. And then what we expect beyond that is that they would use all of the reasonable and supportable information that's available, but without undue cost or effort. So not expecting companies to kind of go to the ends of the earth to find information or to hire all the climate scientists they can, but to use information that is available and that is is both reasonable and supportable if they've got that. Part of what we're looking for here is that companies don't simply have certain plans that they might be talking about in their sustainability related disclosures, but then have different plans when it comes to, say, the financial statements. We're really looking to align those things. So if a company has a particular plan to adapt its processes, procedures, move into or out of certain types of products, or like vehicles, if you're an automobiles company. If that's the plan that you're talking about in your financial statements and saying we don't need to take an impairment because we're planning to do this for the next 15 or 20 years, then you can't have a different viewpoint inside of your sustainability related disclosures. If you've got those plans, that's reasonable, supportable information that you should be using, and there should be some consistency there. So one of the things that we talk about in the standard then is that there's going to be a variation, and so when a company has a particular level of risk or opportunity related to climate, we sort of still recognize that it may take them time to get there, and And so that is understandable, and we're trying to be flexible to a degree here and helping companies to get to where investors need them to be. So maybe just to then quickly kind of talk about some of the interesting things in the metrics and targets portion of what we'd be expecting companies to talk about on climate-related issues. Whenever we mention climate-related metrics, scope 1, 2, and 3, of course, would be something that pops up. A greenhouse gas footprint would pop into people's minds. So we use the same approach of the greenhouse gas protocols. We point to that for classifying a company's exposure to direct or indirect emissions with respect to scope 1, scope 2, and scope 3, as well as also using the greenhouse gas protocol for the different categories of that. One of the things that we sort of recognize, though, as well, is that this information can come from a lot of different sources. Sometimes I feel like people feel like this is a sustainability issue. This is actually just an accounting issue. All reported information in the financial statements, is essentially like an estimate from something, and so we can talk about that if there's interest there. But we have a measurement framework to help companies. We sort of say that the goal here is like use whatever information is going to help you to get the most faithful representation of the measurement that you're looking at. So we want a good assessment of your transition risk using your greenhouse gas footprint. That might mean that you're using direct measurement. It might mean that you're using activity data and emissions factor. It might be that you're using industry averages, or that you're using something that's company specific. So it's not that you have to prioritize the things in the column on the left. It's just all else equal. That's what we would point you to. But recognizing that companies have to assess their circumstances and where their data is coming from. And that's where one place where, again, like I think actuarial expertise could be helpful for understanding what is the most reliable predictor of performance in a sense. In the different categories of scope 15, I also want to kind of point out that we're not, again, asking companies to disclose scope 1, 2, and 3 in all categories of 15 and get everything like just perfectly precise. What we're really looking for is, again, the information that a company has assessed would be material for investors to understand. And so we ask that a company that assesses that it's got transition risk related to its indirect emissions to disclose scope 3, but we're also asking them to say which categories they've decided to include in their assessment of scope 3, making sure that that's going to be information that investors would view as being material. So that's what we're looking for there. I already mentioned that companies need to be in identifying their climate-related risks and opportunities, thinking about what's relevant in their industries. The same thing then is going to play out in terms of like, well, what specifically do they need to say about those topics? And so going back to this industry-based guidance that S2 has developed, maybe back to our example, they need to refer to and consider that guidance. And so, for that e-commerce company, they should not only be talking about energy and water management, only talking about their product and packaging distribution, but following ideally, the guidance that's in the industry-based guidance. So looking specifically at disclosing total energy, how much is the entity pulling from the grid? Is it renewable? What about their water use, et cetera? What's the greenhouse gas footprint specifically of their product shipments? Or for that automobiles company, looking at disclosing what kinds of vehicles are you selling and where, and so this is going to really help to translate information that is could be material information into information that is also decision useful, because peer companies, two automobiles companies or two e-commerce companies, would be disclosing information that is similar. And then just lastly, a note on climate-related targets here. Again, we don't require companies to set targets, but to the extent that they have set them, either voluntarily or by law or regulation, we do ask companies, to the extent this would be material information, to talk about the characteristics of those targets. How do they set them? How do they review them? And how do they benchmark performance against them? So we don't have a ton of time maybe to talk about momentum, so I'll just quickly mention that this has been picked up as being pretty relevant from an investor perspective. So we're seeing investors like BlackRock, large asset managers, asset owners, who had been talking about how they wanted the companies in which they're investing to disclose in line with TCFD and SASB. That had been pretty much the standard since maybe around 2020. They're now transitioning their proxy voting guidelines last year to referring to ISSB standards S1 and S2, the importance of industry and company-specific information. Vanguard saying something similar, but these are just two examples of that. There are others, and that is really sort of reflected in IOSCO, the organization of securities regulators around the world, who endorsed the ISSB standards as being fit for purpose in the use in their members' capital markets around the world. And so just maybe very quickly, where we are at this point, just a little after 2 years of having published the standards, we've got 37 jurisdictions that have already decided to use the ISSB standards on a mandatory basis in their jurisdictions, or are in the process of doing that, with the vast majority of them looking to be what we'd consider to be aligned with the ISSB's standards, and that accounts for about sort of roughly like half of the global activity, economic activity, when you think those jurisdictions do, using different measurements there. And this would be the list of those jurisdictions, so you can see that they are sort of spanning each region of the globe. So with that, I'll go ahead and pause and pass it back. So thanks everybody, and happy to take questions later on.
Okay, thank you very much, Jeff. That was a very quick trip through the standard, but you did a great job. I'm just going to talk briefly for 5 minutes just around the standard itself before I pass it to Evelyn, because Evelyn's got a lot of really good stuff to say as well. So advance the next slide. So ISAP 8, so why did the IAA develop ISAP 8? Well, basically, we do expect actuaries to practice in this area. It would encourage actuaries to sort of develop their work practice in this area. And we also feel it's really important to show that we support the ISSB and its efforts to develop the standards in this area. And so I just threw up here a slide which is right out of the standard itself, which is, well, what is the purpose of ISAP 8 specifically? And you can see I'm going to cover these on my next 2 slides in a bit more detail, so I won't really dwell on this slide. But basically, it's all about how do we present the work we do? What do we disclose? How do we deal with the issue of precision versus spurious accuracy? And how do we sort of comment and emphasize the uncertainties in the work? And so it's really not so much the standard itself, as I keep mentioning, isn't really where you would go to get sort of detailed methodological guidance. It's really more, how does the actuary professionally do their work? So next slide, please. So a few things I think that are important just to point out about the standard. The first is that it's narrowly focused. So it's specifically related to actuaries performing services to support the preparation of climate-related disclosures in accordance with IFRS S2. So it does not go beyond that. So it's a narrow focus standard. So for instance, in the jurisdiction that I work in, primarily Canada, we're looking at climate change. And in our standards locally, and we would, there's a big debate right now about how much do we want to go beyond what's in this narrow focus standard in our own jurisdiction. But this standard itself is only focused on the IFRS 2 disclosures. It might be useful guidance for a reference for other types of actuarial work in the climate change space, but it is very narrowly focused. I guess the other thing to emphasize is that it complements IFRS S2. So just like ISAP 4 complements IFRS 17, you still have to comply with the full IFRS S2, and the actuarial standard makes no attempt to repeat anything that is in IFRS S2. So it is complementary, and it is designed so that it doesn't contradict IFRS S2 in any way. And if an actuary perceives that there is conflict between the standards, I would, emphasize IFRS 2 would take precedence. So again, it's very complementary, and you really have to read the standard in conjunction with IFRS S2. So you have to read IFRS 2 and understand that before you can really use the standard. In terms of timeline, the standard was approved by the IAZC this week, or last week, I should say. So it's going to be going to the council for approval in November. So it will be in place as a model standard then. And in terms of how this then impacts actuarial practice, need to emphasize that IA standards are model standards. So they don't particularly apply directly to any actuary's work. They're a model standard, so then it's up to the national standard setters or the standard setters as appropriate to adopt those standards. So for instance, in Canada, where I work, it would be the CIA's Actuarial Standards Board who would then incorporate this standard into their standards, and then it would apply to the actuaries in Canada. And that's a similar around the world. So you then have to look to your own national jurisdiction to see how and if they've adopted the standard. Next slide. As I covered on just briefly before, the standard it's high level and it's principle based. So basically, it talks about the knowledge requirements you need to have to do the work. It talks about proportionality considerations, which are extremely important in this area because of the fact that obviously there's a sort of whole issue around precision versus accuracy and the potential to do huge amounts of work for something which could be quite imprecise. So there is a fair amount of text on that. A lot of discussion of reliances and use of other party expertise and data. Again, that's quite appropriate because in this space, it's actuaries are highly unlikely to be doing this work completely in isolation of use of other professionals' work or tools developed by other people. For instance, climate change scenarios is an example. Most of those scenarios will not be developed directly by the actuary, but will be using tools and scenarios developed elsewhere. So there's a lot of coverage of the topic of reliances. And then a lot of on the disclosure and reporting requirements. So obviously IFRS S2 it's a disclosure standard, but still how the actuary then discloses his work and what the actuary should be emphasizing in that disclosure is something that we cover in quite a bit of detail in the standard. There's quite a focus throughout the note on assessing and disclosing uncertainty and limitations in measuring the climate-related impacts. And it's quite interesting that when we started the journey to develop the standard a couple of years ago, Ray Muslin, who's now leading the Climate and Sustainability Committee, mentioned to me his one thing he'd like to see in the standard is that we do put a focus on the issues of uncertainty, because that this was something that he felt was important in the climate space. And as it turned out, as the standards developed, there's a lot of text around uncertainty in the standard. In terms of specific requirements in the standard, as I say, it's not really a technique standard, but we do put a heavy emphasis that unless the terms of the engagement or circumstances of the work dictate otherwise, the actuary should be providing quantitative information rather than qualitative, and providing the range estimates rather than single point estimates. So obviously there are reasons potential, but we're trying to sort of say the actuary should start from the perspective, I'm going to do this work quantitatively and I'm going to provide range estimates. If the specific requirements of the standard are the work engagement are different, or in that work the actuary realizes they can't provide that level of precision or estimation, they have to do something different, that's fine. But we do want actuaries to approach this from the perspective of trying to do it quantitatively, providing range estimates. So that's really all I'm going to say on the standard itself. And I will now pass it over to Evelyn and let Evelyn talk about IN 200 and a practitioner's perspective. Thanks.
Thanks, Simon. So IN 200, the main objective really was to, I guess Simon did cover it at the start, but it was formed, I think, around 2024 or maybe mid-2024. The statement of intent was approved by the Insurance Accounting Committee. It's a very long process to do all of that, and everything is done with due process. So very rigorous process to get this IN 200 note out. And the main objective is to support understanding and give some guidance, and it's meant to be educational. So on the right-hand side here, I just wanted to showcase and give shout out to the leadership. So Tara and Dave finished, and lots of members people who contributed to the note itself. Obviously needs to come from a wide range of global representatives, because this is meant to be an international note, and it should contain views from around the world. Next slide, please. And so, as I said, it's meant to be educational, it's non-prescriptive, and in a very, very short nutshell, it's meant to represent good practice rather than required practice. Next, please. So the sections within the note does actually follow the same pillars as the IFRS S2, no surprise. And remember, as Jeff said earlier, the S2 unpacks part of S1 in the context of climate, so we do follow the same pillars as well. So you've got governance strategy, risk management, and metrics and targets. But we do add a bit more spin and flavor as to what actuarial practice or actuarial practitioners in this space should do. And I can step through a little bit in the next 5 or 10 minutes. Next, please. So on this slide, I just want to illustrate there's a very logical flow to the IAN 200. Hopefully when you do see it at some point, you do think it's logical. But if you start from the very high level, we lay out a very high level description of the IFRS S2. And then we also talk about the relevant paragraphs or the paragraph numbers that are useful for reference. Before then zooming into the actuarial perspective as well. So it gives you the whole, why are we doing this according to the IFRS S2, and then what would an actuarial practitioner pay attention to specifically, and examples given as well. So very logical flow. Next, please. In terms of governance, and the next sort of 3 or 4 slides, I'll just step through a very one-pager summary of the IAN 200, like each pillar. So from the governance perspective, I guess Jeff did cover it, but the main objective is to help users of financial reports understand governance processes, the controls in place, how does the company use their controls to monitor and manage and oversee risk and opportunities. So actuaries actually do get involved quite a bit in the governance process, whether they're part of, say, setting a governance framework or developing a governance framework about them, and integrating them into the existing risk management framework or the existing governance framework as well. You could also be involved by reviewing the disclosures prepared around governance, and obviously whether or not governance is adequate within risk management itself or reserving or marketing. So at this point, I think what Simon was mentioning earlier, that no actuary works in isolation, and I think that's very, very true 100% of the time. Even now when I'm dealing with clients and colleagues across the board, not everyone I'm dealing with is an actuary. And everyone's working together to put together something for the disclosures. And so you're definitely going to come across different disciplinaries and different views. And so, yeah, definitely governance is part of it. And so on the next slide, please, we've got strategy. The main ones here is to disclose the company strategy to general users. So actuaries can be involved in a couple of places. I won't read all of them out, but I will call out, say, the uncertainty assessment, because that's something that actually gets called out in almost every section. But it's not something actuaries are, I guess, shy of, in a sense, because we do have experience around setting reserves and product pricing, asset liability analysis, and all involve some level of uncertainty. And we're kind of used to communicating that uncertainty to stakeholders as well. So it's the same thing that same skill set that we use in this climate world, especially when we work around financial estimates or if we're estimating scenario impacts as well. Moving on to the next one on risk management. And the large part of this note actually is dedicated towards scenario analysis, without surprise, because it's quite, well, it's not prescriptive, it's very descriptive of how one could go about selecting the scenarios, how one evaluate the financial impact, and identify potential responses. The note will also talk about useful resources, and I just listed them on the slide. It's part of the IAA work as well that raises awareness about climate-related scenarios, and I think they started this series of papers back in 2021, back when I guess it was relatively new. And this, so an actuary will probably be at some point in their career quite responsible for maintaining best practice for model governance, and it's the same as risk management, scenario analysis, so documentation of the assumptions, its purpose, its trends, as well as its indicators as well. On the next pillar, on metrics and targets, we've got, so it's used to gauge how successful, say, the journey is to reduce emissions and other impacts on the environment of the company. But actuaries could be involved in the monitoring of climate metrics, for example. You could be looking at the modeling of it, or you could also be refining the analysis as well. And remember that control cycle also applies in this case. Control cycle actually does apply to a lot of the aspects, but it also applies to this case as well. You might also be involved if you are working for an insurer who may be engaging with different regulatory bodies to try to develop a framework to calculate Scope 3 emissions, for example. And you could be working with regulators as well and industry bodies. So as an actuary in this company, you could be involved in such an exercise, and that's where your expertise could be called here as well. And I guess lastly, on the next slide, in terms of where things are at, it's already published for exposures to all members on the 17th of October, so 3 days ago. And members associations have about 90 days to comment. So please, if you are a representative of your FMA, please help coordinate and submit comments by the 17th of January. If there's any part of the note that doesn't sufficiently cover something or we miss something else, please point it out to us. And so the Climate and Sustainability Committee will review these comments and then the procedure will continue on. And on this slide, I guess a final note. I think when Jeff first showed up the history of TCFD and then IFRS and everything, it's really good to step back and take a look at the whole, how long or how short actually the whole process has taken, because it started back in 2017 when the TCFD came out, but a lot of development and the standards and all of this educational material as well that the IAA is doing has all come out quite quickly within the last 5 years. So it's a very fast moving field. Not many companies have reported on climate disclosures yet. Yes, some have, but not many. Obviously, this will get more and more in the future. But the should expect some sort of at the regulatory level or at the IAA level, multi-year process of iteration. So that this education material can stay on top of things and making sure we provide up-to-date and relevant information for our actuaries. And on the last slide, I'll touch on, before handing back to Simon, is that obviously then the IAA does have a very strong engagement with key supranationals. IFRS is one of the 6 tier 1 supranationals that we maintain relationships with. And so on this, for example, on the 6th of October, the IAA was represented in another IFRS webinar. And it was exploring scenario analysis, how do you access and disclose their resilience as well. I was on part of the panelists. There was another ISSB board member, Veronica. There was Nish from AIA Group, and there was Ellie Johnston from Climate Interactive. So different perspectives showing that as well. I encourage you to check that out if you have time. And now I might be a good time to hand it back to you, Simon.
Okay. Okay, thank you. So we're going to head into the Q&A in a second. I just a couple of comments I jotted down as Evelyn was speaking. I should say also that in the ISAP 8 itself, we did the same thing as they did in the IEM, which is we followed the paragraph structure of the IFRS S2. So again, we tried to be very kind of user friendly so that you can basically align whereas you're going through the standard, just like the IA, and you can align that to the paragraphs in IFRS S2 itself. And the second thing I would just say is, and I think Evelyn did touch on it, I don't think you need to wait for the final version of IA N200. I would encourage people now, it's out in exposure draft, to read it to give comments, but also just to start to get their education, because it will obviously be an evolving node, and there's a lot of good material in there already. And if you're looking for something to start reading to be able to work in the space or understand the space better, I think working with the exposure draft already is good. So at this stage, we're going to open it up to questions, and I'm just looking at the Q&A at the moment. I think there's just one in the queue, which the question is, excellent presentation, very insightful. Is it fair to say that IFRS S1 and S2 are still Pillar 2 voluntary disclosures? I guess, Jeff, that would be for you.
Yeah, thanks. So I can comment a little bit about this. Yeah, so the way I think about this is that the status of the ISSB standards in different jurisdictions is going to be sort of changing over time, and so most everywhere at the moment it's voluntary, I would say, like right now. But we do know that there are a number of jurisdictions that will be making use of the ISSB standards mandatory for some companies, generally larger public companies, public interest entities. As soon as starting like in 2026, with first disclosures coming out in 2027 under the mandatory requirements. So that is sort of evolving over time. One of the things is also to think about how the standards might be used to meet existing jurisdictional requirements. And so for example, of course, there's been a lot of focus on the CSRD in Europe and on the European sustainability reporting standards. We have worked closely with Europe, and so there is, for example, an interoperability guide that we developed with Europe, with EFRAG, to show how on climate, IFRS S2 could be used to gather information that could also be used to meet the requirements under the ESRS climate standard, or vice versa, that if a company were collecting that information because they were subject to the CSRD, but they wanted to apply ISSB standards, how could they gather information once, use it twice? That is a very technical piece of guidance that we hope would be helpful, but I would caveat that by saying, with the current status of what's happening in the EU with the omnibus legislation, it's sort of remains to be seen exactly where their requirements will land. But one of the things also is that the ISSB has the SASB standards and the climate-related industry-based guidance that I was talking about, and the EU has the ESRS acknowledges that you could use, since they haven't developed their sector-specific guidance, you can use the sector guidance from the ISSB to meet that requirement. And then in the US, where there's no current plan for the federal adoption of the ISSB standards, there is, though, like the California law related to climate, California laws, I should say, and on the law that references the risk reporting requirements, it also has acknowledged that, or identified, the ISSB as being a sort of like a suitable framework that could be used to comply with that rule. And so what we're expecting to see is that one, the mandatory status will sort of evolve over time, as I had already mentioned, and then that ISSB can be used in some cases to meet other jurisdictional requirements. And we hope that sort of like passporting effect will sort of just grow over time as more and more jurisdictions recognize the value of a global baseline there. And then we do expect voluntary uptake from the standards as well. And actually, I just saw something, a report that mentioned that I think it was of the Russell 1000, something like 15% of the Russell 1000 had already started voluntarily using the ISSB standards. So expected to be a bit of a push and pull. Hopefully that helps to put some context around voluntary versus mandatory.
Okay, that's a good complete answer. Thanks, Jeff. Two good questions in the queue here. So one is, the first one here is, what is the status of updating emissions reporting for insurance companies? I understand there are some thoughts about modifying those. Or Jeff, I guess that's you again.
Yeah, that's probably me. So we have a project right now to look at clarifying what the requirements are under the ISSB standards with respect to financed emissions. And when we had originally developed IFRS S2, we as a board had discussed financed and facilitated emissions, and so that was that discussion sort of led us to kind of conclude that there were we saw financed emissions being a useful bit of information for investors, particularly in three industries. I would say, like in insurance, and in asset management, and then also in consumer banks. And so we did specifically call out those three industries and saying that like financed emissions would be required of those industries. It might be relevant information for other entities and other industries, but depending on their circumstances. But in particular, that was going to be a required disclosure for those three industries. But we focused only on financed emissions, and by that we meant essentially like the emissions associated with the investing in stocks and bonds or loans like that. And so we excluded a number of things, but it wasn't really clear that was then, if your companies were disclosing as category 15, could it focus only on the financed emissions, or did it need to did the entity need to include everything that the facilitated facilitated emissions, derivatives emissions, emissions associated with insurance activities, and so this current project is proposing, and we've agreed to clarify in S2 that when a company is disclosing its category 15, which could be a pretty broad construct under the Greenhouse Gas Protocol, they're allowed to focus essentially just on the emissions associated with loans and investments in like stocks, that sort of thing. So just to kind of clarify that, so it's to be part of the original intent. Now we sort of recognize with insurance, so that would exclude some facilitated emissions essentially associated with insurance activities from being part of the required scope. So two important things there. A company that feels like they can assess that, can measure that, and that it would be relevant information for investors can include that in its category 15. If an insurance company wants to do that, that would be fine. So that wouldn't be required, and we sort of expect that, like over time, we can revisit this as the practices develop and we get a better understanding of which parts of this might be the most useful, and what when would that be the case, so that we can then build that framework and structure into the standards. So hopefully that's helpful.
Okay, so the really quick summary is on insured emissions. At this stage, they're still not in the mandatory category. Yeah.
That is correct.
Okay. The third question actually is, I think, a good general question. As a newbie to these standards, are there any sample documents to show how companies are attacking this? I guess they mean the disclosures and doing the disclosures. So, Evelyn, do you have some thoughts on that? And I'll let Jeff have a go.
Well, I'm just thinking about who's adopted it globally. Australia's first disclosures are not out yet, so I can't comment. But I would say even though New Zealand hasn't officially adopted the IFRS S2, there are quite some good disclosures out there and over there that also demonstrates the 4 pillars as well, similar to TCFD. And essentially IFRS S2 is very similar to TCFD in spirit. So you can also look over there. There's some very good disclosures over there. That's my comment, Jeff.
Yeah, it's a good question. We have not at the foundation put out any sort of document saying like this is what we think good disclosure looks like, but it is something that we are thinking about and trying to help we basically want to sort of facilitate coming to a common understanding of what good disclosures looks like. So it's something that we're thinking about. I've seen that I think the accounting firms, for example, a number of them have done analyses that look at disclosures and kind of documenting what different practices look like. One of the things that I could mention is we took over from the TCFD. The TCFD had been monitoring progress on climate-related disclosures on an annual basis, and so when they kind of handed off that work then to us, we this last year also put out a document talking about the status of climate reporting. So that is a pretty extensive document that talks about a lot of what we saw in different jurisdictions, and so that might be a helpful resource, but it's something that we're going to also continue to work on to develop good educational material and guidance that can help companies to apply the standards.
Okay. I think that's it for the questions that were in the queue. We have just a couple of minutes left, so I guess we could probably start a wrap up.
There might be one more. It looks like
there's one more in the Q&A.
Oh, is it? Let's see. Sorry about that. Yes. Okay. Are any comments from the metric side in terms of assets and liabilities under climate change? Should energy assets be depressed on the balance sheet? Should liabilities for P&C, general insurance, life and health companies also be impacted?
I can comment.
Sure.
Yeah. So, what I would say is like I can't say whether they should be, right? It's not a normative decision, but what I can say is that a company that's applying the ISSB standards should be thinking about the extent to which there are current effects. So maybe already it could be affecting the way that entities might be reporting on their financial statements if they've come to understand that they face particular risks or opportunities that would change the way that they would plan to use their existing assets and liabilities, then that depending on accounting rules and their circumstances could play out into remeasurements, for example. So if you start to have stranded assets, it's very likely that that would trigger an impairment under IFRS or other GAAP rules. So it certainly could be the case. What we're looking for companies to do is we're not saying you need to change your accounting. We're just saying you need to, and we're not even saying you need to change your strategies and plans, but to the extent that you have those strategies, plans, that understanding, we're helping companies to disclose that information to investors, talk about how it will play out in the financial statements right now and over time, given the appropriate accounting rules. And I will point to our sister board, the IASB, who's also been working to make sure that there's clear guidance on how to factor climate-related uncertainties into the existing rules under the IASB. So hopefully that is helpful.
Okay. Okay, great. Well, I'll take that as the last question. This was a great session. Jeffrey, I would really like to thank you for participating. It was great to have the ISSB participation. I'm sure we will be doing some more webinars in the future and would love to have you back at some stage. And and Evelyn, thank you so much as well for participating. And I do want to shout out to Evelyn too, because she actually, in sort of a cross-pollination, recently participated in one of the ISSB seminars, which I think was really well received. So, and again, thank you all for attending and for the questions. And as I was saying earlier, the slides and the text commentary from today will be available on YouTube as well in a couple of days. So with that, I'll wrap up and thank you, and have a good day, afternoon, or evening, wherever we are in the world. Okay, thank you. Bye.